Welcome everyone to today's Customs Bond Roundtable. My name is Jennifer Rome and I am the moderator for today's event. The live version of our webinar was presented on June 6th. However, we encountered technical issues with the recording, so this recording was done at a later date. But it still contains all the important information shared in the original session. So let's get started. I'd like to introduce to you your bond management team here at Roanoke Trade. Not everyone could join us for this webinar, but we do have on the call Kathleen Dorman from our Houston office and Tammy Andrews from the Charleston office. Ileana Alvarez and Megan Harrington were not able to join us today. And then also, James Lai is with us from our New York office, and Norma Menjivar is here from our Long Beach office. I've also got Colleen Clark's information up here for you as well, as she is a frequent traveler and attendee of all sorts of national conferences related to bonds. So she's a good resource as well. All right, I thought we'd start out this session to talk about CBP and issuing insufficiency letters. So on a monthly basis, U.S. Customs goes out and grabs all of its active continuous bonds, and it takes a look at bond sufficiency. And if it sees any importer that has a bond that is not deemed sufficient per Customs bond amount calculations, they will render an insufficiency letter or a mandated increase letter to the importer, and then they copy it to the surety. So I wanted to just give you some statistics that we received from Customs. Early May is when we got this information. And you can see we go back from 2004 with just a handful of insufficiency notices all the way up to, like I said, early May 2019. And what I wanted to point out is that huge increase from 2017 to 2018. As it says here on the screen, it was 195% increase. Just to point out, in 2017, it was just shy of 2,000 insufficiency notices. And this is nationwide. This is not just Roanoke. It's for the entire industry. In 2018, there were 5,906 notices issued. And as you'll see, 2019 is well on its way to meeting and probably exceeding last year's numbers. As of early May, there were 4,537 notices issued. That's 77% of the total for 2018. It's been busy. We know all the customs brokers have been super busy, as have we. But I also wanted to point out to you, so Customs issues these letters. We get a copy of them on behalf of the surety companies that we work with. So when we get the letters, we get them in an email. They're individually attached in a Word document. We load them into our software, our workflow software, and it grabs our customer's contact information that we have that's associated with the bond number on the letter that we get from Customs, and we automatically push that letter out to the customer if we have their email address on file, which in most cases we pretty much do. If the bond amount exceeds $100,000, we send that notice to our regional bond departments for handling. The reason we do that is because typically when a bond amount exceeds $100,000, our underwriters will want something for review. Maybe they'll review the importer's history. Maybe they'll want financial statements. Each situation may be different. So we have the field office, our bond service teams, send you the notice when we get one for one of your customers and tell you at the same time, yeah, we need more information, or nope, this one's good to go. Let us know if we can help you with a rewrite of the bond. All right, so after sufficiencies, let's talk about the calculating the bond amount. Tammy Andrews, do you want to talk about that a little bit?
Sure, thanks, Jen. Calculating the bond amount, that's one of the most important things you can do when you do receive a bond insufficiency. And bond amounts are generally calculated at 10% of the duties, taxes, and fees during the last 12 months. At least that's how Customs looks at it. But you really need to also consider the additional tariffs, the 301 duties, when calculating the bond amounts, not only what is in place now, but you should also consider what is going to happen down the road. So when Customs looks at a bond sufficiency, remember they're looking at the past 12 months, and it's the duties, taxes, and fees totaled, including any anti-dumping and countervailing duties that are applicable. Now then, what your next step is to do is to project how much duties, taxes, and fees, including ADD and CVD, the total is going to be for the next 12 months. And then what you end up doing is you take whichever's greater, and then you round that up by to the next 10,000 if your bond amounts between 50 to 100,000, and then after 100,000, we're talking about $100,000 bond increments. So again, projection is key here, and don't underestimate. Always take the greater of the two figures, be it the last 12 months or the next 12 months. And Roanoke has some tools that can help you with that. We've got on our website, there is a, you can actually, there's a bond calculator, and it will help you kind of see where you should be at what bond amount. And it's right there. Jennifer, do you want to demonstrate it?
Sure. I'll put in a couple of amounts for duties, taxes, and fees. Maybe there's only $100 in fees. In this example, you only need $50,000 bond because the total duties, taxes, and fees does not exceed $50,000. But let's add a zero to the duties, and now you need a $500,000 bond. There's not much thinking involved with it, which is great. We've got some customers that do get confused about the increments that you mentioned, Tammy, where do I increase it to by 10,000 or 100,000? I don't know what to do. Just come to the website here on Roanoke's website, and it'll do all the thinking for you.
Yep, I think that's what makes this a really good tool to have.
So some of the other frequently asked questions that we've got, Tammy, so we can definitely use this, but one of the questions we've gotten is, okay, so if I have $350,000 duties, taxes, and fees for the last 12 months, does that mean I need a $400,000 bond? What's your response to that?
Well, if your duties, taxes, and fees for the past 12 months have been $350,000, you need to remember it's 10% of your duties, taxes, and fees. So 10% of $350,000 is only $35,000. So a $50,000 bond would definitely suffice.
For some reason, it helps me to just think $500,000. You know, if it's below that, then $50,000 is all you need.
That's true. That is the easiest way to do it.
Now,
but
what if we have a very...
Yeah.
Go ahead, Tammy. Sorry.
Oh, sorry. Once you get at $500,000, $1, you're going to need that $60,000 bond.
So what if we have a very technical person who likes to see all that technical stuff? We do have on the PowerPoint a few links that are also at the bottom of the screen that I thought we could point out as well, Tammy.
Sure.
The directive. There we go.
Right. Well, you can see, since 1991, Customs has stuck with these how to do the bond amounts. And so, again, you might as well go to this. If you have any questions on the monetary guidelines, they talk about various ways of determining the bond amounts, and while most of it is 10% of the duties, taxes, and fees, sometimes they get into calculating a bond if there have been debit vouchers or, some kind of unpaid claim to Customs. They'll require a larger bond amount.
Yeah, and that one is listed in that third hyperlink on the PowerPoint that has been a little updated since 1991, right?
Right, 2013. Still 6 years old almost, but it's still there. And they call that, when they don't do the standard 10%, they call that the analytical formula. So there's all kinds of situations in that. You can see unpaid or not protested duty bills, delinquent bills, debit vouchers. It's just kind of like add this to that, and bond amounts can become quite high, even when the duties, taxes, and fees seem to warrant a lesser bond amount.
All right.
This is Norma Menjivar, and I will be going over how to calculate the bond amounts. As Tammy mentioned, the bond amount is calculated as 10% of the total duties, taxes, and fees paid in the previous 12 months. We're going to show you several examples of bond calculations. Our first example is one for an importer that has paid $3,500 in duties, $500 in taxes, and $200 in fees. So total duties, taxes, and fees is $4,200. 10% of $4,200 is $420. However, CBP requires a minimum bond amount of $50,000. So if the total duties, taxes, and fees paid in the last 12 months is $500,000 or less, then the bond amount will always be $50,000. In our next example, we have an importer that paid $600,000 in duties, $7,000 in taxes, $1,000 in fees. So the total duties, taxes, and fees paid in the previous 12 months was $608,000. 10% of $608,000 is $60,800. In this case, CBP will require you to round to the next 10,000. Therefore, the minimum bond amount for this example would be $70,000. In our third example, we have an importer that paid $600,000 in duties. This importer also has anti-dumping duties of $75,000. So you've got to remember to add the regular duties as well as the anti-dumping duties into the formula. They had $7,000 in taxes and they paid $1,000 in fees. So total duties, taxes, and fees for the previous 12 months was $758,000. 10% of $758,000 is $75,800. However, the minimum bond amount has to be $80,000 because you're rounding up to the next 10,000. Rounding up to the next 10,000 is going to be required up until you reach a $100,000 bond amount. All bond amounts greater than $100,000 will need to be rounded up to the next $100,000. And that leads us to our fourth example. Here we have an importer that paid $1 million in duties, $106,000 in taxes, $75,000 in fees. So total duties, taxes, and fees for the previous 12 months was $1,181,000. 10% of $1,181,000 is $118,100. So in this case, the minimum bond amount would be $200,000.
Hey, Norma, it's Jennifer again. I just wanted to ask you. So we get this question asked a lot. I know you said it, but I'm going to ask you again. Can I get a $170,000 bond?
No, that is not an option. Per U.S. Customs regulation, you will need to round up to the next $100,000. So it really depends on your total duties, taxes, and fees. You apply the 10% formula to that. Whatever figure you get, if it's under $500,000 in duties, taxes, and fees, then your bond amount will be $50,000. Anything above that, you will need to round up to the next $10,000 if your bond amount is between $50,000 and $100,000. Your bond amount is over $100,000, you round up to the next $100,000. And again, that's the bond formula set by CBP, and the rule for rounding up on the bond amount is also a customs requirement.
So Norma, I'm sitting here thinking about the latest round of China tariffs that have increased to 25%. This is probably a good time for brokers and importers alike to look at the sufficiency of their bonds once again if they're importing any of those commodities subject to the latest round of increases. Would you agree?
Yes, I do agree. And we are definitely encouraging all of the brokers and all the importers to be proactive and to analyze not only their previous 12 months of duties, taxes, and fees paid, but also what they project to pay in the next 12 months, just to be able to identify if you will need to increase your bond. And it's better to do it before CBP issues that mandated increase letter, because the mandated increase letter only gives you 30 days to respond. So previous 12 months, the next 12 months worth of duties, taxes, and fees, compare both figures, and we strongly recommend that the importer focus on the larger number of those two and use that as a tool to determine what bond amount would be best for them for the next 12 months.
All right. Thank you, Norma. Let's talk with Kathleen Dorman from our Houston office about stacking liability.
Hi, everyone, and thank you, Jennifer. So I am going to talk about stacking liability. Stacking liability occurs when a surety company has open exposure over multiple bond periods for a particular importer. While you may hear about stacking liability from the surety company, it is actually not a concept created by the surety company. It is on the bond form and is part of the regulations. On the screen is an image of Section 1 taken from the 301 bond form. As you can see, there is language on the bond form that states, "This bond remains in force for 1 year, beginning with the effective date and for each succeeding annual period. This bond constitutes a separate bond for each period in the amounts listed below for liabilities that accrue in each period." This means that the surety is liable up to the bond amount for every year that there is open exposure on the bond. Open exposure primarily means unliquidated entries. A bond period remains open as long as there are unliquidated entries from that bond. The liability adds up or stacks and creates significantly more risk to the surety company issuing the bonds. In addition to the current bond that is on file with Customs, there can be prior bonds or bond periods that have unliquidated entries, keeping that liability open. So ideally, we want to avoid increasing the bond multiple times in less than a 12-month period, as this creates more liability to both the principal and the surety. It's important to consider the anniversary date of a bond when making changes to it. By keeping a consistent 12-month bond period cycle, an importer can minimize the stacking of their bond periods.
Hi, this is Tammy again. I wanted to talk a little bit more about stacking liability. And so how I like to think about stacking liability is like a Jenga game, to where each bond period is stacking one on top of the other. And of course, as it continues to grow and get higher and higher, it gets a little bit more treacherous. So in stacking liability, we think about bond terms. So in this illustration, let's think about a $100,000 bond. And the $100,000 bond, we have it, let's say its effective date's in January 1 of, say, 2015. So January 1 of 2015 to December 31st of 2015 is year term 1. Think of term, again, not like a term cancellation, but as a period of time. So that's the first year. The second year, January 1st, 2016 through December 31st, would be the second year, the second term or period of the bond, and so on, each year renewing till we're now in the fourth year or fourth period of the bond. Now, the surety has on each of these $100,000 bond terms $400,000 in exposure. And you might think, well, how is that even possible? Because, you know, entries liquidate in 314 days. That's the typical liquidation cycle. Well, if there's anti-dumping, if there's TIB entries that have been filed against the bond, maybe warehouse entries or any other kind of extended, suspended entries, then that creates stacking liability exposure for the surety. And it's important to remember, just because a bond is canceled or terminated, the termination from the surety just doesn't disappear. It just doesn't, go away. All entries are still considered exposure to the surety until they've liquidated 180 days. So most bonds that have been in effect for more than 1 year, they'll always have at least 2 years of exposure going on at any one time, even if their entries are just general entries that are part of that 314-day liquidation cycle. And again, while this example only focuses on one particular $100,000 bond that's in this fourth bond renewal period, the liability can also apply to an importer if they are more, if they have bonds that have to be terminated and replaced because they've added or deleted co-principals, or in the case of insufficiency, which James is going to address further.
Tammy, before we jump over to James, that's a really good point that I actually wanted to bring up on Kathleen's side previously as well, where if you have to terminate your bond midterm, so say your bond has a renewal date of February 1st, and this month Customs issued an insufficiency or a mandated increase notice on it, and says your $50,000 bond needs to be increased to $60,000. So they've terminated the $50,000 bond, but there's still entries on it, and they've now got a $60,000 bond. So how's the underwriter look at that? What's their exposure if they've got a $50,000 and a $60,000 bond?
Well, the exposure would be $110,000. It's not like the exposure gets prorated, so to speak, or, you know, I had a $100,000 bond or a $50,000 bond and it was only in effect, say half a year, you know, just for ease. That doesn't mean that the surety only has $25,000 exposure. If a bond is in effect for just one day, or it renews for just 1 day, 2 days, 6 months, that exposure doubles. So even like a bond that, say it renewed on June the 1st, if it was terminated and replaced with a new bond that went into effect June the 12th, that $100,000 bond renewed again, basically, because remember, as that bond language says, the bond constitutes a new and separate bond for each period that it's in effect. So in that amount, so it's actually creating more stacking.
Which leads us right into James, where I think he has the most complicated slide of our entire presentation today, because Tammy's is ultimately the visual is to talk about a bond that renews, that continues to have open exposure, and so there's the stacking liability. But here's James live from our New York office to talk about what happens when you do have to rewrite the bond midterm. James?
Yes, hi. Thanks, Jennifer. This is James from the New York office. So this slide is an example of how stacking liability affects an importer who receives customs increase notices. So this is a steel importer that has a $200,000 bond initially filed with an effective date of September 18th, 2015. So their import bond renewed at $200,000 on September 18th, 2016, and on September 18th, 2017. So during their 2017 to 2018 bond term, this importer received a customs increase letter requesting a new, where customs is requesting a new $1.3 million bond. So the importer decided to follow the bond amount listed on the increase letter and went ahead and filed a new $1.3 million bond with an effective date of May 6, 2018. Just want to please keep in mind that the bond amount recommended in customs letter is based on the importer's duties, taxes, and fees paid in the previous 12 months. So the importer must also project their duties, taxes, and fees for the next 12 months to determine the correct bond amount. So, you know, a few months after the $1.3 million bond was filed, this importer received another bond increase notice from customs. So this time the importer, you know, correctly projected their duties for the next 12 months and determined that they needed an $11 million bond. So that $11 million bond was filed with an effective date of July 12, 2018. So as you can see on the slide, there are 6 bond terms with unliquidated entries. So because there are open entries on each bond term, the surety has full exposure under each bond term, even though the bond may not be in effect for more than 1 year. So in total, there are 3 $200,000 bond terms, a $1.3 million bond term, and an $11 million bond term. So if you add all these bond terms up, the surety currently have a stacking liability of $12.9 million. So another point I wanted to make is that if, let's say, a letter of credit was required for the $1.3 million bond term and the $11 million bond term, the importer could have eliminated posting an additional $1.3 million in collateral if they projected their duties, taxes, and fees correctly the first time, during that first bond increase letter. So, this is another reason that it is very important for the importer to calculate their bond amount correctly.
Hey, James, it's Jennifer again. Why would there, I think Tammy touched on this a little bit, but why would there still be unliquidated entries from 2015 if the typical liquidation cycle is 314 days?
Right, like Tammy mentioned, there could be a number of reasons, but I believe in this case, there was anti-dumping involved. So, as we know, that anti-dumping entries can take years to liquidate or even decades. So that's why there's still open entries from 2015.
So, okay, so I bet there definitely was collateral involved if there was dumping. And, talking about those mandated increase letters, Norma touched on it a little bit, where you pretty much have 30 days notice to respond to a mandated increase or insufficiency letter. So I'm sitting here thinking once again, $11 million bond that's needed, that's probably covering anti-dumping, countervailing duties. It's not going to be that simple for somebody to go to a bank and get an $11 million letter of credit. Would you agree,
Right.
James? I mean, there's some timing issues that are a problem there.
Right. I mean, unless you're a huge corporation with a large credit line with the bank, it usually would be pretty difficult to obtain a $11 million bond. So it's always better to be proactive and kind of try to increase your bond prior to getting that bond increase letter, which will limit the amount of time you have to post that new bond with customs.
All right, thank you.
Jennifer, this is Norma.
Yeah.
I just wanted to comment that I see a lot of cases where importers are getting insufficiency notices from customs, and the letter from customs has the minimum bond amount that they're now required to increase it to. And I see a lot of cases where importers choose to just increase to either the minimum bond amount that CBP is requesting in their letter, or to just increase it to the next available bond amount. Many times, those importers, if they are importing merchandise subject to the tariffs, more than likely they end up getting another insufficiency notice, maybe within 1 or 2 months later. So either those importers are not projecting what their duties, taxes, and fees will be in the next 12 months, or they have projected what their duties, taxes, and fees would be in the next 12 months, but maybe they didn't project conservatively, and allow some room there either for growth or some room there in the event that their calculations end up, changing. So it's important for importers, and of course with the help of their customs house broker, to really look ahead, again, the previous 12 months and the next 12 months of their duties, taxes, and fees, and consider whether, increasing the bond amount to something higher than what CBP is requesting in the letter. The amount that CBP is requesting in their letter is just the amount that is required of that importer at that point in time when customs ran their reports. But it will eliminate them having to continue increasing their bonds in the near future. And, of course, it will eliminate the stacking liability that James and Tammy just went over. And then, of course, if there's collateral involved, then it will eliminate them having to post, again, additional collateral and getting letters of credit multiple times if they were to increase it for a much larger amount in the first place.
Hey, Norma, have you seen that a lot over the last year where one bond or one principal has received 3 or 4 letters in 1 year?
Yes. I've seen it many times, and it's importers that, for example, had a $50,000 bond, and it was deemed insufficient by customs, and they just chose to increase it to the next available bond amount, let's just say $60,000, and that didn't cover them for more than a few months, if that, and then they got another insufficiency notice, and again, they chose to increase it to the next available bond amount, which was $70,000. So I'm assuming that just means that the importer either didn't understand what it is exactly that Customs is looking at. Maybe they didn't project, further out. So it's really important that that gets looked at closely. Having to cancel and replace, it could create some interruption, not only in your bond coverage, but in your import activity. We here do our best to make sure that we cancel and replace your bond within the time frame that Customs indicates, so you won't have a lapse in coverage. But if there's anti-dumping involved, or if the bond amount gets to be high, or if there's stacking liability, then there's additional time needed, not only for underwriting, but as James mentioned, if you need to obtain a letter of credit, then you have to allow your bank enough time to get you approved for that and to draw up the letter of credit. So it's always best definitely to project conservatively and really look at whether the bond amount you are getting is going to be enough to cover your import activity for the next 12 months.
The customs broker really has a lot on their plate to be able to communicate to their importer and to help them understand, like you were saying, the importance here, and not just wait for the letter and not just do whatever Customs says. Because in the example you just gave, where they had a $50,000 bond and then had to go to $60,000 and then had to go to $70,000, they're probably thinking, what's the big deal? I just need a $70,000 bond. But as we talked about stacking liability over these last few slides, that, to the underwriter's eyes, is $180,000, the combined bond amounts of $50,000, $60,000, and $70,000. And the more that gets higher, like you mentioned, the more scrutiny that underwriter is going to look at, which means the more time it's going to take to get that insufficiency notice completed.
Hey, Jennifer, this is Tammy. Another thought is, too, that brokers and importers have to realize that when Customs is looking at the insufficiency, again, just to reiterate, it's for the past 12 months. It doesn't mean if it's just against that one particular bond. If the importers had 2 or 3 bonds in effect the past year because of underestimating, all those duties, taxes, and fees for the past 12 months are still applicable to Customs review. It's not just this most recent bond that I just got in March is what they're reviewing. They're still reviewing the past 12 months. So like if they were to review today, they would be looking at all of the importers' entries, the duties, taxes, and fees that are assessed against those entries from June 17th of 2018 through June 16th of 2019, not just, say, a current bond.
That's a great point, Tammy, because I want to say that we did get that response from the importer on this example here on the screen when Customs asked for the $1.3 million bond, the $11 million bond. So they wrote the $1.3 million bond on May 6th, and then just 2 months later, Customs wanted an $11 million bond, and the importer, I believe, said, what do you mean? We just got a new bond. It shouldn't be saturated yet. But like you said, it's the last 12 months. It's not the bond term, but Customs is looking at a rolling 12 months, and that's the term of the bond.
Right, and it's even if the importer had a bond with a different surety provider during those 12 months. Those duties, taxes, and fees count too. And, of course, from our side, not being our surety, we wouldn't even have any knowledge of what those figures would be. So, again, another reason they need to work really closely with their Customs House broker.
That's a great point.
Hey, this is Kathleen. I thought I would talk a little bit about another scenario. It hasn't happened too frequently, but we've had a few instances where perhaps an importer has had to comply with an insufficiency and increase their bond, only to possibly have a decrease in their projections of their future duties, taxes, and fees. They've approached us and they've said, all right, I'm not projecting I'm actually projecting a decrease. Can I reduce my bond? So I just want to point out that an importer is actually not really able to decrease their bond until their past 12 months activity supports that.
That is an absolutely great point, too, Kathleen. It's that rolling 12 months. So, like I was mentioning earlier in the presentation, Customs does their review they really are running it the first week of every month, their sufficiency review, to see who they want to issue a mandated increase notice for. And so every month they're running reports saying, give me the total duties, taxes, and fees these importers have paid for the last 12 months. So in June, they look from June 2018 to June 2019. In July, they'll look at July 2018 to July 2019. So it's always whichever is greater. If you, like you said, if you're going to reduce the amount that you're going to pay, you still have to look back at the 12 months, and you look at the next 12 months, and whichever is greater is the amount that you should start at looking at what bond amount you need.
Right, and again, it's also important to keep in mind the anniversary date of the bond and try to make any changes, to coincide with that. That'll minimize the stacking periods.
Great point. We have a lot to talk about stacking liability, don't we? We get lots of questions about it from our customers, and our bond departments are always ready and able to talk with their customs brokers about the subject. So we do hope that this information was helpful to everybody watching the webinar today. Okay, so I wanted to talk a little bit about helping the customs broker communicate to their client, the importer, right? So it is a big deal. It's a lot of work to communicate to the importer why the underwriter is asking for a financial statement or why the underwriter is concerned about stacking liability and so forth. We do have this really great flyer that's on our website today called An Importer's Roadmap, Navigating Financial Requirements and Compliance for Customs Bonds. You can find it at Roanoke Trade, and I just wanted to hop to our website to show you how to get there. So I'm going back, here's where a bond calculator is, but if I go up, this is RoanokeTrade.com is our website, and I'm going to go to Resources, Reference Library, and we have a link on here under the bond section. You'll see we have reference tools for all the different products that we have, as well as some white papers and all sorts of useful information that I really do encourage you to peek around on our website. I'm sure you'll find all sorts of useful information. But if I click the little plus next to bonds, it's the very first flyer here, An Importer's Roadmap. It's a two-page, I think it's a two-page, maybe longer, PDF file that you can print out. It's great information to share with your customer. And not only do we have this flyer for you for a reference when talking to your customer, but we can also white label it. And what does that mean? That means that our marketing department can work with you to make this flyer look like it's your document. So instead of the Roanoke Trade logo, we can put your logo on there and your company name on there. Contact your Roanoke Trade Bond Service representative, and they can get you in touch with our marketing department. But let me just point out a few things here. We talk about what is a customs bond. Great information to copy and paste into an email whenever you are talking to a customer. You'll probably, when you look at some of this language, you might even recognize it because our service team uses a lot of this language quite frequently. We talk about financial statements and indemnity agreements. What is an acceptable financial statement to the underwriter? We have it all right here for you. We talk about the indemnity agreement. In the event that the underwriter needs one, what is it and what do we do? There's all sorts of information in the flyer. We touch on collateral as well, and we even touch on the bond sufficiency review, and finally about the proactive approach that we've been talking about in today's webinar, and the importance of the importer working with his customs broker to figure out the correct bond amount. And finally, about this slide, to assist our customers, we also have this in a Spanish version. So again, contact your Roanoke trade representative, and they can get that version for you. So at this point, we do have time for a Q&A session. As we mentioned earlier, this is a recorded version that was not from the live session, but we did collect all of the questions we received from our live session that I wanted to point out and ask some of our managers on the call today. So if we don't mind, Tammy, you talked about calculating the bond amount. When one of the questions we received is when you're trying to increase the bond amount, it's an interval of $50,000. Is that correct?
Well, no. Unfortunately, it's not correct. It all depends on what the duties, taxes, and fees are, but the increments are, with $50,000 being the minimum bond amount accepted by customs, you go up in $10,000 increments between $50,000 and $100,000. So you could have a $60,000 bond, $70,000, $80,000, $90,000 bond, and then a $100,000 bond. Then after that, Customs requires $100,000 increments, so it'd be a $100,000 or a $200,000 or a $300,000 bond. And then when you get to $1 million, then you would still be looking at $100,000 increments. So it would be like a $1.1 million bond or a $1.2 million bond. And of course, all of that hinging on the totals, duties, taxes, and fees at 10%. And then rounding up to whatever the appropriate increment is, wherever you fall.
Okay, thank you. James, if we could talk about the stacking liability once again. In the example that we gave, you had mentioned that collateral is probably posted for our example. So they had to post two collaterals, one for the $1.3 million bond and then one for $11 million. So, and the question is, if they would have done proper projections, they would have only had to post for the $11 million bond, correct?
Yes, that is correct. So when the importer received that first bond increase notice from Customs, if they were to project correctly and filed a $11 million bond at that point, they would have avoided posting that additional $1.3 million.
Okay. I'm going to ask everybody a question and then give you a minute to answer it because I do want to bring up something else. But if everybody on the call, you may not have a response, but if there's something else that you want to talk about that we have not touched on or that you just want to discuss further, I'm going to ask you to chime in with your comments. But before you do, I wanted to go back to calculating the bond amount. And, early on I talked about how Roanoke processes the mandated increases that we get from Customs. We get them by email and we send them to our customers. We do try to help be proactive, and Roanoke gets data from Customs from the Automated Surety Interface, the ASI, on data on all of our customers' bonds where our sureties are on the bond. So, for example, American Alternative Insurance Corporation, Surety 036, we get all of the bond data. We don't get detailed bond data, but we do get entry numbers, we get estimated entry value, estimated duties, taxes, and fees. So what we do is on a weekly basis, we go out and we grab all of our active continuous import bonds, and we look at the bond sufficiency. And if a bond has reached 90% saturation, so for example, a $50,000 bond, at 90%, it would be $450,000 in duties, taxes, and fees for the last 12 months. We will trigger a notice and email it to our customer to say, hey, heads up, your customer's bond is approaching saturation. So before Customs issues the time-sensitive mandated increase notice, we wanted to be proactive and let you know that this bond may need to be reviewed for a potential increase. And we send a notice that is not any Roanoke logo or anything on it, and we do that intentionally so that you can send it to your customer. You can slap your logo on that document if you want to before you send it to them, to give them just a summary level, hey, your bond, your importer name and number, the bond number, and the total duties, taxes, and fees, and the entry count. So I'm going to veer off slightly for a second and say that that entry count is a great sales tool. It's only a count, but if you know that you're only doing 50 entries and they have 2,000 entries, well, you're not doing all the entries on the bond. So those potential insufficiency notices should be super helpful to you. We do encourage you, when you get those notices, to send them to your customer and offer an opportunity to discuss with them their projections for the next 12 months of their sufficiency. So I'll get off my soapbox. Is there anybody on the call who has anything else that you want to bring up for customers during this webinar?
I would just say to, use the tools that are available on our website, and, when in doubt about how close, what our system is showing for duties, taxes, and fees, if the broker's unsure, just kind of see if we can help guide them and showing them what we have in our system for a particular importer.
All right, thanks, Tammy. All right, I think we covered everything that we wanted to talk about and then some. But again, if anybody who's watching this session has any questions whatsoever, feel free to contact your Roanoke bond representative. And we really appreciate you joining us today. This concludes today's webinar.